Something just changed in XRP that matters more than it looks. Tomorrow's White House crypto meeting is getting all the attention, but the potentially more important development happens the very next day when Brad Garlinghouse joins the CFTC Innovation Advisory Committee. In the next few minutes, I'll connect the August 19th White House meeting, the August 20th CFTC session, and the Clarity Act and XRP's regulatory position, and show you what is actually confirmed versus what remains speculation. The key is the sequence, ladies and gentlemen. August 19th brings crypto executives, regulators, and major financial market institutions together at the White House. August 20th moves the conversation into the CFTC's regulatory process, where 35 members, including Ripple's CEO Brad Garlinghouse, will be part of the Innovation Advisory Committee. And that distinction matters, because this isn't simply about another crypto meeting or another Washington photo opportunity. It's about whether the United States is moving towards a clearer framework for digital commodities, tokenized assets, stablecoins, exchanges, custody, and blockchain-based financial infrastructure. But here is where it gets interesting. The CFTC has explicitly created this committee to bring technological and market expertise into discussions that can inform policy, interpretation, and potential rulemaking. So the question isn't whether XRP gets some guaranteed regulatory decision this week. No. The real question is much bigger. What kind of regulatory system is being built, and where does XRP fit inside of it? Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. And thank you always to everyone who likes and shares each of our videos. These two things really do help out the channel. So who is actually in the room, ladies and gentlemen? Let's start with the people, because the composition tells us something. The CFTC's Innovation Advisory Committee includes Coinbase CEO Brian Armstrong, and 16Z's Chris Dyson, and CME Group CEO Terry Duff, NASDAQ CEO Adina Friedman, DTCC President and CEO Frank LaSalle, Chainlink CEO Sergey Nazarov, Kraken Leadership, Gemini's Tyler Winklevoss, Solana's Lab Antela Yakunov, and Ripple CEO Brad Garlinghouse, among many others. This is not simply a room full of crypto founders, ladies and gentlemen. No. That's the first thing people need to understand. You've got exchanges, you've got clearing infrastructure, you got traditional market operators, you got custodians, you got blockchain companies, you got asset managers, you got prediction markets, you got financial market infrastructure, and you've got regulators. That's a very different configuration from the crypto conferences we've been accustomed to. Because when regulators meet crypto entrepreneurs, the conversation is usually about compliance. But when regulators meet crypto entrepreneurs alongside NASDAQ, CME, DTCC, ICE, and other market infrastructure, the conversation could become much larger. It becomes, how does this technological fit inside the financial system? That's a completely different question. And that is the question XRP holders should be watching. Now you're asking why August 20th matters. Now this is what most people miss. The CFTC isn't creating this committee because blockchain is interesting now. The agency explicitly says the committee is designed to help the commission understand technological change and its implication for financial markets and the U.S. economy. And earlier this year, Chairman Michael Slegg launched an innovation task force focused on developing clearer regulatory frameworks for crypto assets and blockchain technology, artificial intelligence, autonomous systems, and prediction markets. Let this sink in. This is massive. Marinate on this. The CFTC says the Innovation Task Force and Innovation Advisory Committee are intended to help inform commission, policy, interpretation, and rulemaking considerations. The last phrase matters. Rule-making considerations, not guaranteed rules, not guaranteed legislation, but the process through which regulators develop their understanding of the market. And this is where the next distinction becomes critical. The agenda and discussions may influence the regulatory direction, but they don't legally classify XRP by themselves. So if somebody tells you that XRP is officially being classified as a digital commodity on August 20th, that's too strong. The more defensible argument is that XRP's regulatory future is being discussed inside an institutional framework that includes Ripple's CEO and major market infrastructure leaders. That's still significant, but it's different from claiming the outcome is already predetermined. And credibility matters, because if we're going to discuss XRP seriously, we need to know the difference between evidence and speculation. So here's the big question: SEC or CFTC? For years, one of the biggest problems facing crypto in America has been a simple question: who regulates what? The SEC, the CFTC, both, neither, state regulators. The uncertainty has affected exchanges, issuers, banks, custodians, and institutional investors. And the CFTC and SEC have already been moving towards greater coordination. CFTC itself lists a March 2026 joint effort with the SEC to clarify the application of federal security laws to crypto assets, as well as a memorandum of understanding between the agencies. That matters, because the next stage of crypto regulation isn't necessarily about choosing one agency and eliminating the other. It could be about defining the boundaries. And that's exactly where market structure becomes important. Imagine a digital asset ecosystem where everybody knows which regulator has primary authority, where exchanges understand their registration requirements, where custodians know the rule, where institutions know what products they can offer, where tokenized securities have defined treatment, where digital commodities have defined treatment, and where stable coins operate under separate framework. That's not simply a crypto story, ladies and gentlemen. It's important. That's financial market infrastructure. And this is why the Clarity Act matters. Here's the Clarity Act and the political clock. See, the Clarity Act has become the centerpiece of the broader fight over federal digital asset market structure. But here's where we have to be careful. Passing a bill is a political process. Regulatory implementation is an administrative process. And market adoption is an economic process. Those three things can move at completely different speeds. Right now, Congress remains the biggest variable. Recent reporting shows the bill has faced serious headwinds. But the Senate schedule and disagreements over issues including stablecoin rewards complicating the path forward. And that's why the White House meeting matters politically. If the administration brings together crypto executives, regulators, traditional financial institutions, it sends a message about where the executive branch wants the regulatory system to go. But a message isn't a vote, and a vote isn't a final rule, and a final rule isn't adoption. Those distinctions are everything. Still, the political calendar is getting tighter. Congress eventually has to decide whether it wants to create a statutory framework or leave more of the work to regulators. And that's one of the most important choices facing the U.S. crypto market. There's a useful lesson from financial history, ladies and gentlemen. In 1975, the United States moved through a major restructuring of securities market trading with the elimination of fixed brokerage commissions, the event commonly known as May Day. Why does that matter to crypto? Because the technology didn't suddenly make markets more efficient overnight. The rules changed the economic structure around the technology. Competition increased, market participants adapted, financial firms changed their business models, and eventually the market looked very different. That's an important lesson for digital assets. Regulation doesn't have to create the technology. It can simply change the economic environment in which the technology operates. And that's potentially what we're watching right now, ladies and gentlemen. See, the blockchain networks already exist. The exchanges already exist. The custody infrastructure already exists. Stable coins already exist. The tokenization technology already exists. The question is increasingly, what happens when the regulatory system catches up? But here's where it gets interesting. The answer may not be one giant law. It may be a combination of legislation, agency guidance, exchange rules, custody standards, and institutional infrastructure. See, XRP is not just a tokenization story. And that brings us directly to XRP. Because if you only think of XRP as a cryptocurrency that moves from one wallet to another, you're missing the larger institutional thesis. The bigger question is whether blockchain-based settlement becomes part of the infrastructure of capital markets. And Ripple has spent years positioning itself around payments and settlement infrastructure. Now add the names sitting around the CFTC table: DTCC, NASDAQ, CME, ICE, Franklin Templeton, Chainlink, Coinbase, Ripple. These are not random companies. They're pieces of the financial plumbing. And when those companies participate in the same policy conversation, the debate shifts from should crypto exist to how does digital infrastructure integrate with existing markets? That's a much bigger conversation. And this is where XRP's potential relevance comes from. Not because a committee meeting guarantees a price, not because a regulator is secretly preparing an XRP announcement, but because Ripple is participating in the institutional conversation about how blockchain technology interacts with regulated markets. The CFTC officially lists Brad Garlinghouse as one of the 35 members of its Innovation Advisory Committee. That is a fact. What he influences is the interpretation. That's where we have to be disciplined. Let's zoom out even further. In 1944, representatives from dozens of countries gathered at Bretton Woods to build a new architecture for international finance after World War II. They weren't simply discussing currencies. They weren't designing institutions. The International Monetary Fund, the World Bank, a framework for international monetary cooperation. The lesson isn't that today's crypto meetings are another Bretton Woods. They're obviously not. The lesson is that financial systems are often transformed before the public sees the full consequences. The institutions come first. The rules come next. The infrastructure follows. And only then does the average person notice that the financial system has changed, if they ever do. That's why this week deserves attention. The headline is a meeting. The structural question is whether the United States is moving towards a regulatory architecture where digital assets can exist inside mainstream financial markets. That's a much bigger story than tomorrow's photographs. Here is my first analogy of the day. Think about crypto regulation like the early internet. Most people didn't understand TCP/IP. They didn't care how packets moved across networks. They cared that email worked. They cared that websites loaded. They cared that eventually they could buy something online. The underlying infrastructure was invisible. Digital assets may eventually work the same way. The average investor may not care whether or which regulator has jurisdiction over digital commodity. They may not care which clearing system processes the transaction. They may not even care whether settlement occurs on a traditional database or blockchain. They'll care that the transaction settles fast, securely, cheaply, legally. That's the transition we're watching. Crypto may be moving from a standalone asset category towards infrastructure embedded inside existing finance. If that happens, the winning technologies may not necessarily be the ones with the loudest communities. They may be the networks that become part of the plumbing. The institutional infrastructure question, ladies and gentlemen. Let's talk about one of the most important themes buried underneath all of this, tokenization, because tokenization changes the conversation. This is very important. If a treasury security is tokenized, the question isn't simply whether the token is valuable. The question becomes, where does it trade? Where is it custodied? How is it cleared? How is it settled? How is collateral managed? What happens when the market's open 24 hours? What happens when settlement programs become programmable? And who regulates the infrastructure? Those questions are precisely why having traditional market infrastructure represented alongside blockchain companies is so important. NASDAQ, CME, DTCC, ICE, these institutions already operate enormous pieces of the financial system. So when they sit alongside blockchain companies, we're not talking about crypto replacing Wall Street overnight. We're talking about the possibility of Wall Street adopting blockchain components. Let that sink in. That's massive. That's a much more realistic thesis, everybody, and potentially a much more consequential one. Here is the second analogy for today. Think about the railroad industry. Building a railroad wasn't just about laying tracks. You needed standardized gauges, schedules, stations, bridges, signals, contracts, insurance, rules governing how different operators interacted. The network became powerful because separate pieces could work together. That's what regulatory clarity can potentially do for digital assets. It can establish standards that allow exchanges, banks, custodians, token issuers, and settlement networks to interact without every institution reinventing the compliance framework. And that's why regulatory clarity can matter much more than regulatory enthusiasm. You don't need every regulator to become a crypto evangelist. You need predictable rules because institutions don't allocate billions of dollars based on enthusiasm. They allocate capital based on risk-adjusted returns, legal certainty, operational resilience, and infrastructure. That distinction is absolutely critical. What August 19th could actually signal. So what should we watch tomorrow? First, who speaks? Second, what terminology is used. Third, whether the discussion emphasizes legislation or administrative action. Fourth, whether SEC and CFTC officials appear aligned on jurisdiction. And fifth, whether traditional financial infrastructure is discussed as part of the digital asset transition. Because the strongest signal wouldn't necessarily be someone saying XRP, XRP, XRP. It could be something much broader. For example, digital commodities, market structure, tokenized securities, clearing, settlement, custody, interoperability. Those are the words that tell you where the system is going. And this is where short-term noise meets long-term structure. Short-term noise is the headlines. Long-term structure is the architecture being built underneath it. What August 20th could signal, then we get to August 20th. The CFTC's Innovation Advisory Committee is specifically designed to bring market expertise into the regulatory process. And that committee is not a small crypto industry club. No. Its membership span traditional exchanges, market infrastructure, financial institutions, crypto companies, prediction markets, academics, and technology firms. That's the key. If August 19th is about political direction, August 20th is about institutional expertise. And Brad Garlinghouse is sitting inside that process. Again, that doesn't mean XRP receives a predetermined regulatory designation. It means Ripple has a direct seat at a table where the future relationship between blockchain technology and U.S. financial markets is being discussed. That's meaningful. But the market still has to wait for actual recommendations, agency actions, and legislation. And that's where investors need patience, because the biggest regulatory changes rarely happen in one dramatic moment. They accumulate, meeting by meeting, guidance by guidance, rule by rule, product approval by product approval, until eventually the entire environment looks different. The big risk, this is not guaranteed. Now let's talk about the other side, because if we're going to discuss opportunity, we have to discuss risk. The Clarity Act is not guaranteed to pass. Congressional negotiations remain complicated. The banking industry has its own interests. Stablecoin policy remains politically sensitive. The Senate calendar is tight, and the SEC is already moving independently. Reuters reported that the SEC and CFTC are advancing their own crypto policy initiatives, even as Congress struggles to establish a permanent legislative framework. That's important, because the biggest risk isn't necessarily that crypto regulation disappears. No. The bigger risk is that the regulatory framework becomes fragmented. Different agencies, different interpretations, different court challenges, different state requirements, different compliance standards. That could slow institutional adoption. So when people say regulatory clarity is coming, I would phrase it differently. Regulatory clarity may be emerging, but the financial final architecture is still being negotiated. That's the honest version. Let's talk about price versus structure. And this brings us to XRP's price, because I know that's what many people ultimately want to know. But here's the problem. A regulatory meeting doesn't create a guaranteed price outcome. Institutional adoption doesn't happen on a 24-hour clock. And a favorable regulatory environment doesn't mean every token wins. No. Price is reacting. The system's evolving. Those are different things. XRP, the anointed one, could respond positively to regulatory developments. It could also experience volatility of expectations, get ahead of reality. The important thing is to separate the asset's short-term price action from the structural changes occurring around the asset. That's the framework I want you to remember. Short-term noise, long-term structure. Prices reacting, systems evolving. And if the United States eventually creates a clear framework for digital commodities, stablecoins, tokenized securities, and blockchain-based market infrastructure, the consequences could extend far beyond any single crypto asset. The 96-hour timeline. So let's put the entire sequence together. August 19th, the White House, President Trump, crypto executives, financial market leaders, SEC leadership, CFTC leadership, the political conversation. Then August 20th, the CFTC Innovation Advisory Committee, 35 members, Brad Garlinghouse among them, traditional financial infrastructure sitting alongside blockchain companies. The regulatory discussion moves from political leadership toward institutional analysis. Then comes the broader congressional timeline. The Clarity Act remains the major legislative variable. And beyond that, the SEC and CFTC can continue shaping the market through their existing authority. That's the 96-hour window. Not because everything will be decided in 96 hours, but because the direction of the conversation could become much clearer. And that distinction is everything. So here's what I think we should be watching. Don't just watch the photograph from the White House. Watch the language, watch the agencies, watch the jurisdictional boundaries, watch tokenization, watch clearing and settlement, watch custody, watch stable coins, watch how the CFTC describes digital commodities, watch what Brad Garlinghouse says when he's sitting alongside the people who operate some of the most important pieces of American financial infrastructure. Because XRP's long-term story isn't simply, will XRP go up, baby? The large question is, does blockchain-based settlement become part of the regulated financial system? If the answer eventually becomes yes, the competitive landscape changes, and Ripple wants to be part of that infrastructure. That's the thesis, not a guaranteed outcome, not a price prediction, a structural thesis. And that's why I think August 19th, August 20th deserve your attention. The White House meeting is the headline. The CFTC committee is the plumbing. Congress is the legislative battlefield, and institutional infrastructure is where the long-term consequences may ultimately appear. We are watching a financial system try to figure out how to incorporate technology that already exists. And that's a fascinating moment in financial history. Remember, short-term noise, long-term structure. Prices reacting, systems evolving. So keep your eyes on Washington. Pay attention to what's quiet. Keep your eyes on the SEC. Keep your eyes on the CFTC. Keep your eyes on the Clarity Act. And most importantly, watch what happens when traditional financial infrastructure and blockchain infrastructure sit at the same table. If you've enjoyed this breakdown, hit the like button, subscribe to the Crypto Republic, and share this video with somebody who needs to understand what's actually happening behind the headlines. I'll see you in the next one, ladies and gentlemen. Hope everyone's having a blessed day. This might be one of the most epic proportional rants we ever do. I want to welcome all the new members of the Crypto Public Desk Monthly inside the Patreon, all new members of the membership channel. None about what I'm about to say is financial advice. It's just my own opinion, and it retains any capacity. A lot of people are getting cut up like sushi globally. Ladies and gentlemen, this is a pivotal time in the world. This are positions I am watching, okay? I'm going to give you the macro trades I'm watching right now because I think there are some very interesting divergences of developing across global markets. And importantly, I'm not looking at this as a blanket call to get out of equities. Quite the opposite. The broader asset allocation picture is actually becoming more constructive. Global earnings momentum is improving. Macro momentum is improving. And softer U.S. wage growth could reduce the urgency for the Fed to act aggressively. So for me, the question isn't whether I want risk. It's where I want that risk. Ladies and gentlemen, if you want the deeper macro research, understand one tip from the pits can pay for your entire year's subscription. Join over 670 active traders inside the Crypto Public Desk Monthly. What I'm about to give you right now are some of the things we're following. Trade 1, short U.S. consumer. First trade I'm in, watching a short U.S. consumer discretionary. The position is short RSPD against long global cyclicals. And the global cyclical explosions I'm watching includes MXI, IXN, IXG, IXC, and EXI. The reason is pretty straightforward. U.S. consumer spending is weakening, and the underlying fundamentals are becoming increasingly lackluster. So I'm not interested in blindly chasing the reality and rally in U.S. consumer stocks. I'm watching for further downside in U.S. retail sales because if the U.S. consumer starts to crack, consumer discretionary is one of the areas I want to be very careful with and not to get caught up like sushi. Trade 2. This is not financial advice, just my own opinion. Not financial advice. Long Taiwan, baby. Second trade I really like is long Taiwan. EWT all the way. And the reason is resurgent chip price momentum. That is important. Taiwan is directly exposed to the semiconductor technology cycle. If chip prices continue to strengthen and global technology demand remains solid, Taiwan has a direct earnings tailwind. So I'm much more interested in owning that momentum than chasing areas where the fundamentals are deteriorating. Trade 3, not financial advice, just my own opinion. Anyone takes in capacity. Long Taiwan, short India. And then we get to the relative trade I find so interesting and lovely. Long EWT Taiwan, short EPI India. India's economy has remained resilient, but I'm seeing a much more complicated macro backdrop developing underneath the headline growth numbers. We got elevated oil prices. We got weak rainfall and an uneven monsoon. We got inflation pressure. We got rupee pressure. We got signs that the domestic momentum could be starting to fade. India has taken policy steps to support the rupee and manage the fiscal impact. But I'm asking a simple question here, and I'm going to tie all this into XRP. Stay with me. I'm taking the PhD out of PhD on this class trip, baby. You're going to want to see the end when I get to where I'm going. It's all about XRP and how and why we got here. Don't turn off the channel. How sustainable are those measures if oil stays elevated? Because high oil can't hit India from several directions at once. It can put pressure on external balances. It can increase inflation, and it can make more difficult for policymakers to support growth. Foreign inflows have started to improve, which is encouraging. But if local momentum continues to weaken, I think that ultimately could put a lid on asset returns. So I'm not saying India collapses. That's not the trade. This is a relative value trade. I'm saying right now, I'd rather own Taiwan semiconductor momentum than India's increasingly complicated combination of oil, inflation, currency, and growth risks. Is the bigger picture. And this is where I think the broader strategy gets relatively interesting. I'm not simply saying sell risk. The opposite's happening. I'm actually becoming more constructive on equities because global earnings are improving and macro momentum is improving. Softer U.S. wage growth may also reduce the urgency of the Federal Reserve to act aggressively. We go over this all the time, ladies and gentlemen. That supports the equity story. But we're not trying to get caught up like sushi every day, up, down, left, right. Oil up, no, this, more, This is how you take the PhD out of PhD and you make it happen as a financial mercenary. You find that alpha underneath rocks on the Serengeti in the dry season. We're also seeing a rotation back into equities from high yield credit. And I'm paying attention to the upgrade in both industrial metals and precious metals. So I'm looking at a pretty clear combination. I want to own equities where earnings momentum is improving, not financial advice, just my opinion right there's any capacity. I want to expose to Taiwan in the semiconductor cycle. I want global cyclicals. I like to set up for industrial metals and precious metals. And I want to be more selective around U.S. consumer discretionary and India. There's also another macro trade I'm keeping on the radar. Long 10-year gilts versus JGBS, bonds, and U.S. Treasury. The idea is that the market forces of those markets are diverging. So when I put everything together, I'm not simply looking at buy everything or sell everything environment. I'm looking at relative momentum, where earnings are improving, whereas the economic cycle is strengthening, and where the risks are starting to pile up. So the position I'm watching are short RSPD, long MXI, IXN, IXG, IXC, EXI, long EWT, short EPI, and within the broader allocation, long industrial metals, long precious metals, long 10-year gilts versus JGBS, bonds, and USTs. For me, the message is pretty clear. Don't run from the risk. Don't get caught up like sushi. Don't FOMO this. Be selective about where you take it. We are the remora. I want my capital position where earnings and macro momentum are accelerating. I want to reduce exposure where consumer spending is weakening or where oil inflation, currency, and growth risks are starting to pile up that we see every day on the television. Death from 1,000 tweets. Stay away from this. That's the institutional positioning I'm watching right now. And ladies and gentlemen, that brings me to the bond market because I think what's happening in rates actually reinforces a lot of what we're seeing across these equity trades. So the bond market's sending a warning, ladies and gentlemen. I want you to understand something. What I'm going over as a financial mercenary is why. We're getting to XRP right now once I go through this. This is what we say to people that retain its capacity and why. Because there's a reason. If you're only looking at one side of your coin, you never see the other side of the coin. You just get caught up like sushi by themes. Oil up, memorandum of peace, garbage, this, Doesn't make any sense. What makes sense watching the chaos is your capital get cut up like sushi. You got to look for a different place to go. But right now, the steepening trade is still firmly in control. And frankly, it's becoming increasingly difficult to argue against the momentum. Make no bones about it. What I'm saying to you right now is why these meetings are happening the 19th and the 20th. Why what we say every day when we rant and rage about what's going on with the metals market over in Hong Kong. Why this is happening. Why these meetings are important. Why they're pushing ahead no matter what. As China and the BRICS unit copies the U.S. system and the west side of the tranche, the west side of the tranche, baby, is upgrading. And this is why. And at the end of this rant, I'm going over XRP and why in ICP. The U.S. 30-year Treasury yields have pushed above 5.3.0, taking them to fresh cycle highs. The 30 curve has broken above the 200-day moving average, and the 5s and 30s is now getting very close to its own 200-day moving average. That's important. We talk about the AI war every day. This affects the functioning of funding the AI situation. Stop. Pay attention to the news. There's meetings behind meetings. So the question for me has changed. It's no longer simply, does the curve steepen from here? The more important question is, when do we reach the point where real money investors start stepping in aggressively and saying enough is enough, which is coming? Because that's ultimately what I'm watching. At some point, these yields become attractive enough for pension funds, insurers, asset managers, and other long-duration investors start buying in size. This is this is what's really going on, what moves the market, not the kabuki theater or drama you see. This is what it takes to be a financial mercenary, baby. We aren't seeing that clearly enough yet. And that's why I don't want to fight this move prematurely. What's particularly interesting to me is that the market still doesn't appear to be pricing a completely new permanent inflation regime. If this was purely an inflation story, I would expect to see much more aggressive repricing across the front end of the curve and a much larger adjustment expectation for the Federal Reserve. We're not seeing that yet, but that's not really what we're seeing. The adjustment's happening primarily through the long end. We're seeing higher term premium. We're seeing fiscal concerns. We're seeing energy uncertainty. We're seeing enormous capital demand associated with the AI investment boom. We go over this every day. And all those things are forcing investors to demand more compensation to own long-term duration government debt. And that's why the curve is steepening. The front end isn't doing all the work here. In fact, December OIS is still already pricing another hike this year. But most of the recent adjustments have been curve-driven rather than a dramatic repricing of the Fed path. I mean, if you're writing all this down, you've got so much to work with. I can't believe I'm giving away this for free. You want to see how we actually make money off of this and how you trade off of this, how you invest off this, how you don't get cut up like sushi? Join the Crypto Public Desk Monthly, ladies and gentlemen. It's out of our Patreon. One tip from the pit pays for everything. Join over 670 active traders. See, ladies and gentlemen, this distinction matters because the market isn't necessarily saying the Fed is going to lose control of inflation. The market's saying, I need more compensation to lend money to the government for 20, 30 years because you're $40 trillion in debt. That's a very different message. Now, oil is doing a huge amount of the heavy lifting. Brent has moved through 91 a barrel as expectations for U.S.-Iran deal deteriorated further. There never was a deal. It's amazing. They write about nothing. It's like reading garbage. It's fake. The latest headlines aren't exactly helping. Trump and POTUS has been signaling limited appetite for extending the current truce framework while criticizing Oman's mediation efforts. The market is therefore starting to treat the Strait of Hormuz situation less like a short-term diplomatic problem and more like a potentially prolonged supply risk. And that's critical for rates. Because if the oil shock persists, central banks have to be cautious. They may not want to react aggressively to every move in energy prices, but they also don't want to make the mistake of assuming that an inflationary shock is temporary. If it starts feeding into broader prices and expectations, that makes long duration bonds less attractive, lower yields. And that is why I think the long end is going to remain under pressure until we see evidence of genuine institutional demand. This is not financial advice, ladies and gentlemen, only in my opinion, and retains myself an organization in capacity. We have housing starts, import, export prices, industrial production coming through. Honestly, I don't think the market's primarily trading the data right now. It's trading oil and the curve. That's the story. And with 5s, 30s approaching the 200-day moving average, this is becoming a very interesting technical test. The question is whether fresh steepness still have enough fuel to keep pushing higher, or whether we're approaching the first real point where the challenge and the trade gets questioned. Now, Europe is telling us essentially the same story. German 30-year yields are approaching levels we haven't seen since 2011. French 10-year yields are above 4%. Ladies and gentlemen, this is clearly no longer just a U.S. Treasury story. This is a global duration story. Do you understand what that means? If you don't, put it in the comment section, because if you're still here after 34 minutes, I know I'll take you seriously by answering this. This is happening around the world. We're seeing a lack of appetite to buy the dip, and that's pushing the 10-year bond yields beyond multi-year ranges. The OAT bond spread is around 85 basis points. We're roughly 88 basis points, representing the multi-year wide. And today we've got the $3 billion German 30-year syndication. Do you understand how nuts that is? The timing is interesting, to say the least. You're asking investors to buy long-duration German government debt at exactly the moment when global curves are steepening and long-end bonds are being sold. Germany has generally had good success absorbing supply this year, but I'm not expecting some kind of disaster. What I'm watching is the execution very closely. If the syndication absorbs smoothly, it could temporarily stabilize the German long year. Ladies and gentlemen, I don't think one successful auction is enough to reverse the broader global duration story. See, this is why they have to meet and get something going. Because the world is broke. That what it means in English, what I'm saying. The world is broke, ladies and gentlemen. It is. And again, look at the front end. Eurobond pricing isn't showing a huge appetite to reprice the ECB path. So once again, the pressure is concentrated in duration and term premium. Higher oil, global fiscal concerns, and the U.S.-led sell-off in the long end. Those are the dominant forces, ladies and gentlemen. UK is no better, unfortunately. The first part of the week's UK labor market data was somewhat softer than expected. Private sector wage growth was broadly in line, but unemployment expectedly rose to 4.9%. Employment disappointed. Payroll was disappointed. Previous months were revised lower. So the UK labor market story is becoming less benign. The probability reinforces the Bank of England's current wait-and-see approach. Once again, UK rates aren't operating in isolation. The domestic data matters, but the much larger global steepening trade is dominating. It's everywhere. UK curve steepened again, and the 4 billion sterling July 2036 gilt auction gives another test of demand for duration while global long-end bonds continue cheaper. Ladies and gentlemen, if you look at Asia, you see the same thing. What this means in English, if you're still here, the world is broke. The world's broke. Asian equities are taking a risk-off tone as oil moves higher and global rates sell off. Japanese government bonds have steepened with the belly underperforming following a strong JGB auction. The 5-year was very strong. So when I take a step back and I look at the entire rates complex, I see dominant themes. Long end is under pressure globally. This isn't simply about Federal Reserve. It isn't simply about European inflation. It isn't simply about the Bank of England. We're seeing a broader repricing of duration globally. I think investors need to understand why. And we're dealing with higher energy uncertainty. Europe's not going to have enough energy. They're just not normal. They're 60% where they're normally right now. They're in trouble. We're dealing with fiscal concerns. We're dealing with enormous government borrowing requirements. We're dealing with increased term premium. We're dealing with massive investment associated with the AI bailout. And that creates a moment where investors may require a higher yield before they're willing to lock up capital for decades. And that's why I'm not particularly interested in arguing that the move has already gone too far. It might have, but the market hasn't proven that yet. The technical levels are getting close. The 5s, the 30s approaching its 200-day moving average. Real money demand is the next thing I want to see. If institutional investors step in aggressively, that could be the first real sign that the steepening trade is reaching a point of exhaustion. But until then, I'm respecting the trend because markets can stretch a lot longer than people expect. And right now, the message from the bond market is pretty simple. Higher yields, steeper curves, and investors demanding more compensation for uncertainty. That's the story I'm watching, ladies and gentlemen. And here's the part I think people really need to understand. The question isn't whether the curve can steepen anymore. It clearly can. The question is where the buyers finally step in and what yield do pension funds, insurers, asset managers, and real money investors finally look at the 30-year treasury and say, that sounds good. That's enough. I'm buying. We're getting close to that test. But until I see that institutional demand come through in size, I'm not going to stand in front of this move and get run over by a moving Mack truck or freight train. I'm going to respect the trend because markets can stay stretched a lot longer than people expect. And if this continues, this isn't just a bond market story anymore. It becomes a story about fiscal policy, currencies, commodities, equities, and ultimately the entire global financial story. That's where this gets really interesting because when the cost of long-term capital changes across the world's major economies, the consequences do not stay inside the bond market. They eventually show up everywhere. And that's why I'm watching the long end, not just because high yields or yields are going higher, but because the bond market may be telling us the price of money itself is changing. So when I put all this together, equities, commodities, bonds, I'm not looking at isolated market moves. I'm looking at the repricing of risk across the global financial system, ladies and gentlemen. None of this, what I just said, is financial advice. Just my own opinion, and it retains any capacity. This video is for entertainment, education purposes only. Always consult your licensed financial advisor. Never invest a dollar based on watching a YouTube video. Don't ever do that. The XRP story is so important right now because everything I just went through, and if you're still here, I salute you. You know why? The financing of the world's debt cannot continue. You have every major economy steepening. They can't do it anymore. So when people get afraid and upset about XRP's prices going down, ICP prices going down, ask yourself this question. Do I have your attention now? Where would you rather put your money? In garbage bonds by countries that have been fighting wars for how many years now that are completely broke? That you're not going to make anything, you're going to make ungats? Or would you rather put your capital in a ticket for the future? XRP, ICP, HBAR. What would you rather do? Does what I just said make sense? It should. Let me tell you something. If you want to see how to take advantage of all this, come and join us. Because for me, I love being a financial mercenary. I'm born for this. We eat the fresh sushi. But when you start crying about, it's going down, he made a video, oh my God, it's going to go 60 cents. You should say thank you for an opportunity to get this again. Everybody's extra liquidity for the Ripple people because they're making this and they're getting rich. Do you understand what they're buying and why? You have no idea. We do. But then again, we answer to family offices and families and sovereigns. So we have our necks on the block every day. This video is 41 minutes for a reason. This is an epic rant. Understand why tomorrow, the 20th, so important. Because of what I just said. There's no taking the PhD out of PhD. They're going to get things done. They're going to force rules down people's throat. And when they force rules down people's throat, that's when Congress begins to act. Whether they do or don't, where do you want to put your money? Government garbage bonds? I just went over around the world, they're garbage. You want to be a slave to the economic situation of higher oil. I don't like him, we'll shoot this missile. Or do you want to get ahead? Getting ahead is taking that frosty march up that frosty mountain where it's dark and it's cold. But from the mountaintop and the vantage point, it's spectacular. I love all my haters. This is for you who wrote the comment. XRP is the future. You don't understand the financial system enough to understand that we have to change, and our main adversary is copying our financial system. You have to be patient. It's not about I've been holding something from this time point to that time point. It's about what I just said in this video. Transcribe it. Write it down. It's free. I can't believe I gave this away for free. I just explained to you why the world is changing without some psychotic price prediction. It's gonna go. You want to know why this is the future? Watch the video again, print it out, and ask yourself, do you want to give money to broke countries, governments who put us in a quagmire where the value of your money is disappearing every day? Or do you want to buy a ticket for the future? XRP, ICP, XRP, ICP. I love you all, ladies and gentlemen. I'm going to see you on the front lines. This video is for education, entertainment purposes only. It's not financial advice. Always consult a licensed financial advisor. Never invest $1 from watching a YouTube video. I love you all, ladies and gentlemen. I'm going to see you on the front lines.